Is Devon Energy a potential buy now? We're going to perform a DNV stock analysis. We'll reverse engineer Warren Buffett's decision-making process to look at the most telling business numbers for Devon Energy. Then we'll use 3 different methods to estimate their fair value. Along the way, there's going to be a key bonus metric. It just might be the tipping point when analyzing Devon Energy for your stock portfolio. You're going to want to watch till the end of the video because their fair value and our rating may surprise you. So, is Devon Energy a potential opportunity? Right now, DVN stock trades for $47.34 per share. This year has been rough on the business. Their stock price is down 18.5%, while the S&P 500 is up 10%. But that's not all for shareholders. Right now, Devon Energy pays a 7.3% dividend yield. This yield is added to their returns in their stock. In the last 5 years, it's a completely different story. Devon Energy compounds at 13.5% annually. Plus, they pay dividends. They beat the market in this time. In the last decade, they're down 23% overall, still about flat, including their dividends. When we go back 2 decades before the global financial crisis, Devon Energy's stock price is flat in the last 18.5 years. Still with dividends, they've given positive returns to shareholders, but they underperform the S&P 500. The burning question is, why should we be paying close attention to Devon Energy? Right now, the company trades just $5 above their 52-week low. They're down $25 from their 52-week high. About 2% of their shares are sold short. And how big is Devon Energy? They're decently sized. They have a $30 billion market cap. Devon Energy, based in Oklahoma City, is one of the largest independent exploration and production companies in North America. The firm's asset base is spread throughout onshore North America and includes exposure to the Delaware, Stack, Eagle Ford, Powder River Basin, and Bakken plays. At year-end 2022, Devon's proven reserves totaled 1.8 billion barrels of oil equivalent, and net production that year was 611,000 barrels of oil equivalent per day, of which oil and natural gas liquids made up 73% of production, with natural gas accounting for the remainder. Recently, both oil giants ExxonMobil and Chevron made huge announcements of big acquisitions. Chevron's acquiring both PDC Energy and Hess, while ExxonMobil is acquiring Pioneer Natural Resources. Devon Energy is looking at their own merger and acquisition options with both Marathon Petroleum and Crown Rock. This may only be the start of more serious consolidation in the oil and gas markets. Now with this understanding, let's dive deep into their numbers. We're going to start with metric number 1. In it, we want their average returns on capital to be above 14%. In a normal business, these returns are around 7% each year. When we look for a benchmark that's double that, we can build in margin of safety based on the quality of the business. Devon Energy, as an integrated oil and natural gas exploration and production company, will see that their returns on capital will be cyclical with these commodity prices. That's reflected here on this graph. As the price of oil crashed in 2020, their returns on capital plummeted. Then as oil rebounded, their returns went sky high. They earned 41% returns in 2022. In their last 12 months, they've earned 32% returns. When these are averaged out, even though they've had very low lows and very high highs, the company averages 14.8% average returns on capital in a given year. That's just above the benchmark we want. It's a check on metric number 1. We want sales, earnings, and free cash flow growth in our second metric. This growth across the board will support their returns on capital. Devon Energy is a commodity business that operates in a cyclical industry. Just like their returns on capital, we see that cyclicality in their growth. The company was shrinking going into 2020. They had negative earnings in 2019 and in 2022. Meanwhile, the company did have positive free cash flows in all 5 of these years. That's something to like as a shareholder. Devon did see a big boom since 2020. Today, their sales are almost double where they were at in 2018. Their earnings are up 56%, with the company earning $4.7 billion in their last 12 months. And the company's free cash flows have almost doubled. They earned $1 billion in free cash flow in their last 12 months, after earning around $3 billion in 2021 and 2022. This is growth across all 3 of these. It's exactly what we want to see. This is a check on metric number 2. Metric number 3, we want earnings per share growth. This looks at Devon Energy from the view of an individual shareholder in the company. We learned in our last metric their earnings have grown by 56%. At the same time, the company was buying back shares going into 2020. Then their shares increased in 2021 and in 2022. This was due to 2 big acquisitions. They bought WPX Energy for $2.6 billion in 2021. This gave them oil and gas properties in the Williston Basin and the Permian Basin. And then in 2022, they bought Validus Energy for $1.8 billion, giving them more assets in the Eagle Ford Basin. The company both added debt and issued shares for these acquisitions. They've diluted shareholders by 30%. Still, their earnings grew faster than their shares outstanding. This means Devon has grown their earnings per share. It's a check on metric number 3. So far, Devon is perfect through our first 3 metrics. How will the company perform in the second half of our analysis? Metric number 4, we want to see something similar to our last metric. We want free cash flow per share growth. As we learned previously, their free cash flows have almost doubled over this time. That outpaces their 30% shareholder dilution. Their free cash flows have grown. It's another check on metric number 4. Devon Energy is still perfect. Before we look at their balance sheet and get to our valuation estimates, why don't we check in on our bonus? Right now, Devon Energy pays a 7.3% dividend yield, but is their dividend yield safe and can this grow in the future? We're trying to figure this out through our bonus. We want their dividends to be supported by their free cash flows. Even with their ups and downs, surprisingly, Devon Energy has supported these in 4 of the last 5 years. 2020 was the only exception for the business. They've also grown their dividends in all 5 years. That may not be the most rational capital allocation decision, especially in 2019 and 2020. Although as the price of oil has rebounded since 2020, the company has had a lot of excess capital, which they've been able to return to shareholders. Devon Energy supports their dividends today. They've also supported these in the last 3 years. It's what we want to see. This is a check on our bonus, and they're still perfect. In recessions, it's businesses with too much debt that can have the biggest losses and even go broke. We want their net debt to be below the sum of their free cash flows in their last 5 years. In this time, Devon Energy has tripled their net debt position. They had $2 billion worth in 2018. They grew their net debt to $5.4 billion in 2022. Today, they have $6.3 billion of net debt. Even though they've grown their net debt, they've grown their free cash flows even faster. The company may have been in trouble supporting these in the years leading up to 2021. Since then, they've had a ton of free cash flow. They produced $7.1 billion of free cash flow in their last 5 years, most of this coming in 2021 and 2022. This is able to support their debt position, so it's a check on metric number 5. Please be mindful that they produced $1 billion of free cash flow in their last 12 months. If we project that out into the future, that doesn't fully cover this debt load. You need to understand how this debt is structured, when it matures, and what rates it's at to get a better picture if this will cause issues for Devon Energy or not. Still, we're flawless through our first 5 metrics. Does Devon Energy have what it takes to go 6 for 6 on our analysis and be a perfect Select 6 stock? Let's find out. The big metric of them all, metric number 6, we want Devon Energy's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a risk premium to the 10-year treasury. It's the first of 3 ways we'll estimate a fair value for the company. Right now, they have an enterprise value of around $37 billion. This adds their net debt and their market cap together. It looks at Devon almost like a private company. In their last 5 years, we learned they produced $7.1 billion of free cash flow. In an average year, they produced $1.4 billion of free cash flow. When we divide that by their enterprise value, we get a 3.8% average free cash flow to enterprise value yield. That's about in line with the yield from the 10-year treasury. Today, they produced $1 billion of free cash flow in their last 12 months. This means when we divide it by their enterprise value, we get a 2.9% current free cash flow yield. That's below the 10-year treasury. Even though their average is in line, these both come in under our risk premium. This means coming in all the way on metric number 6, this is our first and only X of the day for Devon Energy. Don't just throw this business out. You're going to want to see what their other fair values are, because when we put these together, it may surprise you. Everything we've discussed so far is important, but there's still something missing. This, in my opinion, is the main reason to analyze Devon Energy. It brings us to look at a discounted cash flow model to estimate their fair value per share. A discounted cash flow model is like any model in any field. Its outputs are sensitive to its inputs. We're going to start with an average of their free cash flows in their last 3 years. This includes a very bad year for them in 2020. It also includes 2 good years. Free cash flows can be lumpy year to year, which is why we take this average. We'll use historical assumptions to grow these into the future, but it's up to you to figure out if these are accurate or not for Devon Energy. If we assume they grow their average free cash flows at 8% in each of the next 10 years, Then in the following decade, we'll assume this growth rate is cut in half and these only grow at 4% annually. We're also going to add in their tangible book value to give an estimate of their net worth. If we want a market-beating 15% rate of return, which is what Warren Buffett looks for from his investments, at today's valuation multiples, an estimate of Devon Energy's fair value per share is around $51. That's $4 above their current stock price. Please keep some key points in mind. They're an integrated commodity producer that operates in a cyclical industry. They've taken a beating even compared to their peers in the past year, yet they haven't been that predictable in their past, which makes this fair value a rougher estimate than it would be for some other companies. This discount rate is based off their free cash flows. It already includes their huge dividend yield. Compared to their history, Devon Energy trades at a pretty low price to owner earnings. Historically, in the last 10 years, they traded at around 11 times. Today, they trade under 6 times. Still, the company trades around their typical price to operating cash flow in their last 10 years. Guru Focus also estimates Devon Energy's fair value. Right now, this comes in around $50 per share, pretty close to our discounted cash flow valuation. Guru Focus uses analyst estimates and the company's historical multiples in order to calculate this value. But with low business predictability, this estimate suffers from that same result we're looking at for our discounted cash flow model. It's a rougher guess for the business than usual. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before you consider any investment decision, consult with your financial advisor. So far, we've looked at a lot of the numbers Warren Buffett cares about, but it's the qualities of a business that are even more important to him. Let's learn what these are for Devon Energy. We're going to start with a long thesis. Number 1, Devon's acreage is ideally located in the core portions of the basin in which it operates. That translates to an above-average well performance and peer-leading supply costs. Number 2, Devon's shareholder-friendly capital allocation plan opens the door for substantial returns to shareholders via a base dividend, variable dividend, and opportunistic share buybacks. Number 3, by capping growth at 5% annually, Devon avoids the risk of overspending during upcycles, which is a common fault of upstream firms. But it's not all sunshine and roses for the business. Let's look at a short thesis as well. Number 1, after incorporating sunk costs on leaseholds, acquisitions, exploration, and infrastructure, Devon's capital base inflates to a level that puts long-term excess returns on capital likely out of reach. Number 2, the profitability of Devon's Permian assets is unmatched elsewhere in the portfolio. Other basins simply aren't as profitable. Number 3, production growth could periodically outpace midstream capacity additions in the Permian Basin, causing bottlenecks and volatile basis differentials. Now let's revisit their fair values and combine those qualities with their numbers as we give a rating. So far in our stock analysis of Devon Energy, ticker symbol DVN, they look pretty good based on the numbers. Even though they're a commodity producer that operates in a cyclical industry, they have well-positioned assets in the basins they operate in. Throughout the recent 5 years, they've earned above average returns on capital. They've also grown a ton and they've made some big acquisitions. The company still grows on a per share basis. They've also added on debt, but these are supported by their free cash flows historically. Shareholders have seen a boom in the capital that's returned to them. The company has increased their dividend payouts. They have both a base dividend and a variable dividend that depends on their cash flows. The big knock to the business came when we looked at their free cash flow yields. These yields don't give a premium to the 10-year treasury. Keep in mind this analysis is not financial advice. When we combine the ways we've estimated Devon's fair value, if you want a market-beating rate of return, we get a fair value per share for Devon around $45.50. That's just a couple dollars below their current stock price. This comes even after the big run-up in the business in the last few years. Devon goes 5 for 6 on our Select 6 analysis. When we combine their numbers with their business qualities, they look like a great candidate for more research, especially considering the recent M&A in the oil industry. If you enjoyed today's DVN stock analysis, like it, subscribe to the channel for more, and watch this next video.